Welcome to the Smart Investing Podcast, brought to you by Money and Me, an investor education and awareness initiative by PGIM India Mutual Fund.
Hello and welcome to a brand new episode of Smart Investing, everybody. Ahalya here, keeping you company on the podcast, brought to you by PGIM India Mutual Fund. Now, it has been a while since we brought you a conversation, but listen, this one's totally worth the wait because today we're spotlighting something that doesn't often find itself on the table of conversation, and that is investment styles. You know, I think in all of our personal finance journeys, we do have the tendency, once we find a trusted financial advisor, to sort of completely blindly trust them and hand over the reins to them and just let them take control, right? Because we get comfortable. But the one thing that we don't account for is that every financial advisor who uses mutual fund houses to help us build wealth is dependent on the investment styles of these fund houses. So, like in life, we've got preferences, we have a way of doing things. So why should investing be any different, right? We should be considering the styles that fund houses implement and follow so that we can align our financial goals with those styles and therefore with those fund houses. So a very interesting and not often spoken about topic of conversation. Let's hand it over to Ravi and Lisa to dive into it further.
Thanks, Ahalya. Today we are diving into a topic that doesn't get talked about enough, which is investing styles. Most of us have heard about large caps, mid caps, or small caps. But did you know how a fund manager picks stocks can also impact your returns? So there's a bit of an art to it. So let's explore the different investing styles and what they mean. We have with us Lisa to demystify this topic. Welcome, Lisa.
Hi, Ravi. Yes, you're right. Does not get discussed enough, and we must talk about different investing styles and how they impact overall portfolio return.
Yes, so we often talk about diversifying across large caps, mid caps, or small cap stocks. But there's another side to diversification that many investors overlook, which is the style.
Absolutely, Ravi. In fact, just the other day at a book club, someone asked me about trend investing. That got us talking about something called momentum investing, which is actually a type of investing style, just like growth, value, or even quality.
Interesting. So investing styles are basically different ways fund managers pick and manage stocks, right?
Exactly. So think of them like approaches or mindsets fund managers use when picking investments. Traditionally, we have two big style buckets, so to speak, growth and value. But there are more like momentum, quality, and even styles that try to generate what's called alpha, which basically means extra return.
Okay, so how do these styles affect my returns as an investor?
Okay, so in the short to medium term, say 2 to 5 years, investing styles can have a big impact on returns. Some styles work better in certain market conditions. So, for example, when the economy is booming, growth stocks might do well. During uncertain times, value stocks may shine. But here's the thing, you can't really predict this beforehand, which style will work best when, and that's why diversifying across different styles makes most sense.
Yeah, Lisa. So I think many investors might not have heard about growth and value investing style. So can you please explain the difference between both in simple terms?
So growth investing is like betting on tomorrow's star. Value investing is about finding a hidden gem on sale today. In the investment parlance, a growth strategy of investing focuses on selecting stocks where the earnings growth of the underlying business is expected to outperform its peers in the future. Now, that outperformance of earnings lends to the expected stock value and rise in price even before it happens. So we're talking future earnings, but price rise today. Typically, in a growth strategy, stock prices move ahead of earnings growth on expectations. And this type of strategy works well, as I said, in growing economies, high growth sectors, new age industries, and in an environment where a sector or an economy is recovering from, say, a downturn. you are essentially looking for companies where the growth in earnings is expected to be above average as compared to the peer set. Investors and fund managers are willing to invest at higher prices or at valuations which exceed the reasonable level, as long as this earnings growth expectation holds. So that's growth investing. Now, value investing, in contrast, looks at the current market price of a stock and tries to find if it is undervalued based on the expected earnings growth of the past trend and the future. In value style, one does not buy at any market price, right? Like we did see about growth. And one does not chase above average earnings growth. Value investors are simply trying to cash in on the underpriced stocks with the potential to deliver above average return.
Got it. So growth is all about betting on future potential, while value is looking for those hidden gems at a good or bargain price. Am I right?
Yeah, exactly, Ravi. And these styles don't always perform at the same time. For example, from 2005 to 2012, value outperformed in the Indian markets. Then growth took over till around 2018. Then value made a comeback again. So rather than trying to guess who wins in a particular period of time, it's smarter to own both across time periods.
Okay. Lisa, I'm also hearing about these new investing styles like, momentum or quality. It sounds very fancy, but what do they mean?
Yeah, they sound like, it's something that one needs to own all the time. But see, momentum investment is all about riding the wave. It means buying stocks that are already going up and hoping that they'll keep moving up more. Think about it like joining a party that's already happening, but being ready to leave before it gets too boring.
Yeah, sounds exciting, but what about the risk aspect? Will these kind of funds have higher risk?
Yes, exactly. Trends like momentum can reverse quickly. So momentum needs active monitoring. If you're doing this through, say, a mutual fund scheme, it's best to keep your allocation small and be aware that it's more short-term focused. Now, quality investing, also you asked about, is more patient. It's like choosing companies that are strong, well-managed, and financially healthy. These are the good students, so to speak, of the market. They may not be the cheapest, but they're more reliable over the long term.
So for someone like me who's a long-term investor, quality is more long-term and stable, right?
Yeah, it leans more towards, the buy and hold philosophy, but investors still kind of need to be careful not to overpay, even for quality.
Right. Lisa, I'm also hearing about this term called alpha. So what is this all about?
Alpha is just a technical way of saying extra returns over the benchmark. Funds that try to generate alpha usually use a mix of styles like momentum and growth. But remember, markets are unpredictable. Sometimes alpha funds do well, sometimes they don't, just like any other scheme. So again, don't put all your eggs in one basket.
Right. Lisa, there are many different kinds of funds in the industry. So how do I know what style my fund is following? So if I'm investing in a mutual fund, how do I know which style my fund is following? Is there a way to find out?
So the investment style and strategy is usually mentioned in the scheme's offer document, the scheme information document, and it will be mentioned like if it's called a value fund or momentum fund, then you know that it's in the name itself. In other cases, it depends on the fund manager's personal style. If they've been around for a while, then they do have a unique style. Some fund managers only follow growth, some fund managers only follow value. For regular investors, it's not always obvious, and not everyone will go into the scheme information document to find out what style the fund follows. That's where a financial advisor can help. But a simple trick is to diversify across different fund houses and fund managers. That way you naturally get a mix of styles.
Right. Lisa, equity mutual funds are mostly, long-term products. You hold them for 5 years, 10 years, 15 years. So are some styles better suited for like long-term investors?
Yeah, great question. So as we have gone through quite a few of these styles in the discussion today. Growth and value, as we mentioned, are more traditional and they have stood the test of time. Whether you're investing for 10, 15 or 20 years, both have delivered over these long periods of time. Momentum, alpha, on the other hand, are more short to medium term focused. They can do really well for a while, but you have to be ready for volatility when the trends reverse.
Yeah, great, Lisa. So I think today's podcast was a little bit technical, and I think if investors spend a little more time, researching about funds and what style they are following, I think they'll be able to, diversify across styles. So I think we have covered a lot of ground today, and I would like to summarize my learnings from our conversation. So the big idea is this: don't put all your money in one investing style. Diversify across sectors or market caps. After this is done, diversify across growth, value, quality, and even a little bit of momentum. So each has its time in the sun, and together they can smooth out your ride. I was looking at some data and I found that high quality stocks were favored by investors when they were bearish, and quality tends to have low return volatility. And in bullish markets, momentum may give the strongest performance. And if you find it difficult to understand what style your fund follows or how to identify different styles, it's best to consult a trusted financial advisor who can find the right fit for you. So that's what we have for this episode. Thanks, Lisa, for this insightful conversation.
Thank you, Ravi. Thank you for having me.
So interesting, right? And very important for us to think about. Thank you so much to Ravi and Lisa for that deep dive. Short and sweet is how we're keeping it on today's podcast, but it's quality over quantity, right? I really hope that you all took something away from the conversation today and that it's given you better insight into the different investment styles that surround us, how to identify and recognize them, and how you can align your own financial goals with these investment styles and vice versa. We'll catch you very soon with another podcast, but in the meantime, happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
You are listening to the Smart Investing Podcast, brought to you by Money and Me, an investor education and awareness initiative by PGIM India Mutual Fund.